Tom, rough tape. Tell me about demand here, because my fundamental question sort of is, are customers seeing the value of AI in a difficult economic environment, or is it more of an ambitious growth want to have versus a need to have?
Well, our revenue grew 38%. This is roughly $250 million business. We grew at 38% last year. That's a growth rate increase from 17% the year prior. So that would be in the top decile of rapidly growing enterprise application software companies. Our customers like Shell, LyondellBasell, and others report, Enel report receiving, $1, 2, 3, $4 billion a year in economic benefit from the use of our products. So I think the value is there. Again, we have a $250 million business growing at roughly a 40% compound annual growth rate. I'm sorry, $250 million business, $1 billion cash in the bank. And I think this is a company that is positioned to be a leader in enterprise AI.
So what explains the deferred revenue issue? It seems like a slowdown versus expectations and versus where you had been in the past. So how is this economic environment or competition or whatever it is affecting your demand pipeline?
Well, let's look at, revenue growth. Again, up 38% year over year. I think it was 38 or 39% in the quarter, which is very rapid. In terms of deferred revenue, I mean, we have a relatively small number of relatively large transactions, so our billings can be lumpy quarter to quarter, and that'll work itself out over time as we reach scale, but that lumpiness is still there. And I remember, Q2 of this year, billings were low. At the same time, we grew revenue, but I think 38%. And, and billings were a little bit down, but they do tend to bounce around at the scale that we're operating. They tend to, bounce around a little bit from quarter to quarter.
Hey, Tom, on your earnings call last night, you talked about a changing market environment and how investors are looking for more profitability. You said that you have a robust executable plan to achieve positive free cash flow in the next 2 to 3 years. Can you outline that plan for us? What do you need to do? Can you do more than just cut marketing? Are you going to cut headcount?
We're absolutely not going to cut headcount. We're hiring, and we're hiring all over the world. We have basically 80% gross margin. We will reduce. We've been spending 26% on marketing programs. We'll rationalize that down to about 11. We spend about 23% on sales. We'll continue to do that. We spend 46% on R&D, which is a lot. There's a massive investment in technology, but there we reach economies of scale. So when you're running a 80% gross margin business, it's not that difficult to run a cash positive, profitable business. And so we will do that. That being said, we do have $1 billion cash in the bank. I think our negative cash flow last quarter, free cash flow, was roughly $15 million. So at that rate, we'll run out of cash in, I think, 65 quarters. So we have a little bit of runway to do this. But right, as you know, with 80% gross margin business, it's not that easy, difficult to be profitable.